There are moments in financial history when the surface appears calm, but beneath it, the structure is already beginning to crack. Most people do not notice these moments when they arrive. They notice them later, after the headlines have changed, after prices have moved, after confidence has already been lost. That is the nature of financial crises. They rarely announce themselves clearly. They begin quietly, in the language of debt, policy mistakes, liquidity shortages, and misplaced trust. Silver sits at the center of one of those moments. I do not say that lightly. I have watched markets through inflationary cycles, banking crises, currency shocks, recessions, bailouts, and geopolitical disruptions. And one lesson has remained constant through every decade. The public usually looks at price while the serious observer looks at structure. Price is only the surface. Structure is where the truth lives. Today, the structure behind the global financial system is more fragile than most people understand. Debt is higher. Trust in paper money is weaker. Central banks are more constrained. Governments are more dependent on borrowing. Geopolitical alliances are shifting. Supply chains are no longer neutral. And liquidity, which everyone assumes will always be there, may disappear precisely when it is needed most. That is why silver deserves attention, not because it is fashionable, not because it promises certainty, not because any asset can be reduced to a simple prediction. Silver matters because it stands at the intersection of several forces that are now moving together: monetary instability, industrial demand, currency distrust, geopolitical tension, and the human instinct to seek something tangible when paper promises begin to feel uncertain. For years, investors were trained to believe that central banks could solve almost anything. If markets fell, central banks would cut rates. If banks came under pressure, liquidity would be injected. If governments overspent, debt could be rolled over. If currencies weakened, officials would reassure the public. The entire modern financial system has been built around the assumption that confidence can be managed. But confidence is not a machine. It cannot be printed. It cannot be ordered into existence by a policy statement. It exists until one day it does not. That is the real risk. When debt becomes too large, it is no longer just an accounting problem. It becomes a political problem, a social problem, and eventually a monetary problem. Governments begin to rely on inflation, financial repression, and currency depreciation as invisible tools of adjustment. They may not announce it. They may not even describe it honestly. But the burden has to move somewhere. And historically, when the burden moves onto the currency itself, people begin looking for assets that do not depend on another person's promise. Gold is the more famous refuge. It has always been the monetary metal of kings, central banks, and nations. But silver has a different character. It is both monetary and industrial. It belongs partly to the world of money and partly to the world of production. It is used in electronics, solar technology, medical equipment, precision instruments, and many parts of the modern economy that cannot simply function without it. That dual identity is what makes silver so interesting. When investors seek protection from monetary instability, silver can attract capital as a hard asset. When industry expands, silver faces demand from the real economy, and when supply is constrained, those two sources of demand can collide in a market that is much smaller and more sensitive than people realize. This is not about excitement, it is about asymmetry. In normal times, silver can be ignored, it can drift, it can frustrate investors, it can remain undervalued longer than people expect. But markets do not move only because of value, they move when value meets a catalyst, and today the catalysts are gathering quietly. The first catalyst is debt. Across the world, governments have borrowed at levels that would have once been considered extraordinary. Debt has become normalized because the consequences have been delayed, but delayed consequences are not canceled consequences. They accumulate. They become embedded in the system. They reduce flexibility. They make every policy choice harder. A highly indebted system cannot tolerate high interest rates for long. It cannot tolerate recession easily. It cannot tolerate deflation without stress. It cannot tolerate inflation without political anger. So, policymakers are trapped between outcomes they do not like and promises they cannot fully keep. In that environment, currency becomes the pressure valve. This is where many people misunderstand money. They think money is stable because it has a name, a symbol, a government behind it, and a long history of acceptance. But money is not simply paper or digits or bank reserves. Money is trust. It is a shared belief that the claim you hold today will still be accepted tomorrow. Once that belief weakens, people do not wait for permission to change their behavior. They move quietly at first, then quickly. The second catalyst is central bank credibility. For decades, central banks were seen as the adults in the room. They spoke in careful language, they managed expectations, they provided liquidity when markets trembled. But central banks also help create the conditions they now struggle to control. Years of cheap money encouraged leverage. Years of asset inflation widened inequality. Years of emergency policies made markets dependent on rescue. A system that always expects rescue eventually loses discipline. That is why the next phase is so delicate. Central banks may still have tools, but their tools are no longer cost-free. If they tighten policy too much, they risk breaking debt markets. If they loosen too quickly, they risk weakening the currency and reigniting inflation. If they do nothing, they risk appearing powerless. This is the quiet corner into which modern finance has painted itself. And when investors sense that policymakers are trapped, tangible assets begin to look different. They are no longer just alternatives, they become forms of insurance. Silver, in that sense, is not merely a metal. It is a vote of no confidence in the permanence of paper wealth. The third catalyst is geopolitics. The world is no longer moving toward one integrated financial order. It is fragmenting. Sanctions, trade restrictions, payment system rivalries, reserve currency questions, and strategic resource competition are all part of the same story. Finance has become a battlefield. Currencies are no longer just economic instruments, they are tools of power. When nations begin to question the neutrality of money, they also question the systems through which money moves. That matters for precious metals. Gold has already re-entered the thinking of central banks. Silver, though not held by central banks in the same way, benefits from the same psychological shift among individuals and investors. The more uncertain the world becomes, the more people value assets that are outside the political promises of any one government. Silver is not someone else's liability. That is a simple sentence, but it carries enormous weight. A bond is someone's promise to pay. A bank deposit is someone's liability. A currency is a claim backed by confidence in a state. A stock depends on earnings, valuations, and market liquidity. But physical silver, properly held, does not require a counterparty in the same way. It exists. In a world overloaded with promises, existence itself becomes valuable. The fourth catalyst is industrial demand. This is where silver separates itself from pure monetary assets. The modern economy needs silver. It is one of the most conductive metals on Earth. It appears in technologies that are not shrinking but expanding. Solar panels, electric systems, electronics, medical uses, and advanced manufacturing all rely on silver in different ways. This creates a tension that is easy to overlook. If investment demand rises because of financial fear, and industrial demand remains strong because of technological growth, then supply must satisfy both worlds at once. But silver supply cannot be summoned instantly. Mines take time. Refining takes time. Logistics take time. Above-ground inventories are not infinite. Markets often ignore supply constraints until they cannot. That is why silver can move violently when sentiment turns. It is a smaller market than gold. It is more volatile. It is less patient. When capital enters quickly, there is not always enough available supply at the old price. The price must move to find sellers. This does not mean a straight line. Nothing in markets moves in a straight line. Silver can rise sharply, fall suddenly, confuse investors, and test conviction. Volatility is part of its character. Anyone who approaches it without humility is likely to be punished. But volatility is not the same as risk. Risk is not understanding what you own, why you own it, and what role it plays. For some, silver is speculation. For others, it is insurance. For disciplined investors, it may be a small but important part of resilience. The mistake is confusing those purposes. Insurance is not purchased because you hope your house burns down. It is purchased because you understand that the unthinkable is only unthinkable until it happens. That is how I view precious metals. They are not about greed, they are about continuity. They are not about predicting the exact moment of crisis. They are about surviving the loss of confidence when others discover too late that confidence was the foundation all along. The fifth catalyst is psychology. Markets are human systems disguised as mathematical systems. We cover them with charts, ratios, models, and equations. Those tools matter. But beneath them is emotion, fear, greed, denial, envy, panic, relief, and disbelief. The most dangerous stage in any financial cycle is not panic. Panic is obvious. The most dangerous stage is complacency. Complacency tells people that because something has not broken yet, it cannot break. It tells them that because central banks rescued the last crisis, they will rescue the next one. It tells them that because a currency has survived for decades, it will survive without cost forever. It tells them that risk is low because prices are calm. But calm prices can be the most misleading signal in finance. Before major dislocations, markets often appear stable. Volatility may be suppressed. Credit may still flow. Officials may sound confident. Commentators may dismiss concerns. The public may continue as if nothing important has changed. Then confidence shifts, and when confidence shifts, the repricing can be faster than the preparation. That is why preparation matters more than prediction. Prediction asks, when will it happen? Preparation asks, am I resilient if it does? The second question is far more useful. Silver belongs in that conversation not because it solves every problem, but because it addresses a specific weakness in modern portfolios. Many portfolios are built almost entirely on financial assets: stocks, bonds, funds, pensions, accounts, digital balances. These assets can perform well in normal conditions, but they share a common dependency. They rely on functioning markets, liquid institutions, and confidence in currency. A tangible asset introduces a different kind of risk exposure. It is not perfect. It has storage concerns. It can be volatile. It produces no income. It must be sized carefully. But those limitations do not erase its purpose. In fact, they clarify it. Silver is not a replacement for everything. It is a counterweight to a world where almost everything else depends on trust in the same system, and that system is under strain. Look at the pattern. Debt expands, money supply expands, governments promise stability, central banks manage expectations, asset prices rise, the public becomes comfortable. Then inflation appears, or a banking problem emerges, or a geopolitical shock interrupts supply chains, or a currency comes under pressure. Suddenly, what looked stable is revealed to be fragile. This pattern has repeated throughout history in different forms. The names change, the technology changes, the institutions change, but human behavior does not change as much as we like to believe. People overborrow in good times, they underestimate risk when liquidity is abundant, they trust systems that reward confidence, they panic when the system demands collateral instead of promises. Silver responds to that old human rhythm. It is not magic, it is not immune to market forces, but it has a historical memory. It has survived empires, paper experiments, banking failures, monetary reforms, and political promises. That does not mean it always rises. It means it retains a role when confidence in abstractions begins to fade. The gold-to-silver relationship is another part of the story. For centuries, investors have watched the ratio between gold and silver as a rough measure of relative value. When silver becomes deeply discounted relative to gold, it often suggests that silver is being overlooked. That does not guarantee an immediate move. Markets can ignore value for a long time, but when a catalyst appears, undervaluation can become fuel. And today, the fuel is not just monetary, it is industrial, it is geopolitical, it is psychological. That combination is rare. The mistake many investors make is waiting for certainty. They want the chart to confirm everything, they want the news to agree, they want experts to bless the decision. But by the time everyone agrees, the opportunity has usually changed. Markets do not reward certainty, they reward preparation under uncertainty. This does not mean acting recklessly, it means thinking clearly before emotion enters the room. If someone chooses to own silver, the first question should not be, how much can I make? The first question should be, what role does this serve? Is it insurance? Is it diversification? Is it a hedge against currency debasement? Is it a long-term store of value outside the banking system? The answer determines the behavior. Without that clarity, volatility becomes frightening. With clarity, volatility becomes something to endure rather than something to obey. The second question is allocation. No serious risk strategy depends on one asset, one prediction, or one outcome. Concentration may create excitement, but resilience comes from balance. Silver can play a role, but it should not become a religion. The financial world is uncertain, and uncertainty demands humility. The third question is form. Paper silver and physical silver are not the same thing. A trading product may offer price exposure. Physical silver offers possession. Each has advantages and limitations. A person seeking short-term exposure may think differently from a person seeking long-term insurance. Confusing the two can create disappointment. The fourth question is emotional discipline. Silver can test people. It can move sharply and then retreat. It can make investors feel brilliant one week and foolish the next. That is why any decision made in excitement is dangerous. The time to decide your purpose is before the move, not during it. In moments of systemic stress, the greatest enemy is not volatility, it is improvisation. Improvisation under pressure leads to poor decisions. People buy when they feel fear of missing out. They sell when they feel temporary pain. They chase headlines. They mistake noise for signal. They turn strategy into emotion. The prepared person does not need to predict perfectly. He needs to avoid being forced into bad decisions. That is the deeper lesson. We live in a time when the financial system has trained people to confuse liquidity with safety. If you can click a button and see a balance, you feel safe. If markets are open, you feel safe. If banks are operating, you feel safe. If central bankers are speaking calmly, you feel safe. But safety is not the same as access. Access can change. Liquidity can change. Rules can change. Confidence can change. And when they change, they tend to change together. This is why tangible assets have always had a place in serious thinking about risk. Not because they are old-fashioned, but because the oldest forms of protection often survive the newest forms of failure. Silver is humble. It does not have the prestige of gold. It does not dominate central bank vaults. It does not sit at the center of international monetary diplomacy. But that humility may be part of its appeal. It is accessible. It is useful. It is tangible. It has both monetary memory and industrial necessity, and when the world begins to question paper, humble things can become important. The public usually comes late to this realization. At first, silver is ignored, then it is debated, then it is chased. By the time it becomes obvious the quiet accumulation phase is over, I am not interested in panic. Panic is not a strategy. I am interested in recognizing when multiple pressures are converging on the same point, and today silver is one of those points. Debt pressure is converging, currency pressure is converging, industrial demand is converging, geopolitical fragmentation is converging, distrust of financial promises is converging, and beneath all of it is a broader question: how much confidence can the system demand before people begin to look elsewhere? That is the question silver answers in its own way. It does not answer with speeches. It does not answer with policy papers. It answers by existing outside the promises that define the rest of the financial world. When people say silver is just a commodity, they miss the point. Oil is a commodity. Copper is a commodity. Wheat is a commodity. Silver is a commodity with monetary memory. That memory matters when trust becomes scarce. And trust is becoming scarce. Trust in governments, trust in central banks, trust in currencies, trust in institutions, trust in the idea that the future will resemble the recent past. Once that trust weakens, people begin to reassess what they own. They ask different questions, not what is rising today, but what survives if the system changes. Not what looks safe on a statement, but what is safe if statements lose meaning. Not what will make me rich, but what will help me remain standing. That is the shift. Silver is not about fantasy. It is not about a guaranteed outcome. It is not about turning fear into marketing. It is about understanding that the financial system is more fragile than it appears, and that fragility has consequences. The great illusion of modern finance is that complexity equals strength. In reality, complexity often hides weakness. The more interconnected a system becomes, the more a shock in one corner can travel to another. A funding problem becomes a banking problem. A banking problem becomes a confidence problem. A confidence problem becomes a currency problem. And when the problem reaches the currency, everything is affected. People think of currency as neutral. It is not. Currency is the measuring stick for value. If the measuring stick itself becomes uncertain, all prices become political, psychological, and unstable. That is when tangible assets begin to reassert themselves. This is why silver matters now. Not because tomorrow is certain, not because any one target is inevitable, but because the underlying conditions that give silver importance are becoming stronger, not weaker. A disciplined person does not need to react emotionally to that. He simply needs to understand it. He can look at his financial life and ask whether everything depends on the same system. He can ask whether his assets are all promises. He can ask whether he owns anything that does not require a counterparty. He can ask whether he is prepared for a world where liquidity is not guaranteed and confidence is not permanent. These are not questions of fear. They are questions of maturity. The prepared investor is not the one who predicts every crisis. No one does that. The prepared investor is the one who understands that crises are part of the system, not interruptions of it. They are not exceptions. They are consequences. And consequences have a way of arriving slowly, then suddenly. Silver may be one of the clearest symbols of that reality. It is overlooked until it is needed, quiet until it moves, simple until the system becomes complex enough to make simplicity valuable again. In the end, the case for silver is really a case against complacency. It is a reminder that paper wealth depends on trust, that debt cannot expand forever without cost, that central banks cannot repeal human behavior, that governments cannot borrow without consequence, that liquidity is not the same as solvency, and that the most dangerous risks are often the ones dismissed by respectable opinion. I have seen this pattern before. The details change, but the psychology does not. People laugh at protection when times are calm. They question insurance when nothing has happened. They call caution unnecessary because the disaster has not arrived. Then, when the shift comes, they discover that preparation was not pessimism, it was wisdom. Silver is not a promise of certainty, it is a response to uncertainty, and in a world where uncertainty is rising, that response deserves serious thought. The system looks stable from a distance, markets still open, banks still operate, currencies still circulate, officials still speak in calm voices, but stability on the surface does not always mean strength underneath. Sometimes it means pressure has not yet found the weak point. That is why I return to the same principle again and again. You do not need to predict the crisis perfectly. You need to be prepared enough that the crisis does not define you. Silver may not be the whole answer. It never was. But it may be one of the few assets that still reminds us what money used to mean before it became a promise, a policy tool, and a political instrument. It reminds us that value can be tangible. It reminds us that trust can fail. It reminds us that preparation is quieter than panic, but far more powerful. And when the world finally notices what has been building beneath the surface, the prepared will not need to shout. They will simply understand why they prepared in the first place. The greatest risk is believing there is no risk.